In 1985, your parents could buy a house for 3 times their annual salary. Today, you need to. In 1985, a college degree cost $40,000. Today, it's $40,000 a year. In 1985, saving 10% of your income actually meant something. Today, it barely covers inflation. Your parents gave you advice that made them millionaires. Following that same advice is making you broke. And the worst part, they have no idea. This isn't about blaming anyone. This is about numbers. Cold, hard, mathematical reality that nobody wants to talk about because it means admitting that an entire generation's blueprint for financial success has become obsolete. Not wrong when it was written. Just expired, like milk left in the sun for 40 years. Let me show you what I mean. August 1982. Paul Volcker, chairman of the Federal Reserve, stands in front of Congress. Inflation has finally been tamed. Interest rates on savings accounts hit 14%. Your parents could put $10,000 in a basic savings account and watch it grow to $11,400 in 12 months. No risk, no stock market, no crypto gambling, just free money for existing. That same year, the median home price in America was $69,000. The median household income was $23,000. Do the math? That's a 3-year ratio. 3 years of gross income bought you a house. Not a down payment. The entire house. Fast forward to today, median home price, $436,000, median household income, $74,000. That's a 5-9 ratio, nearly double. But it gets worse because in 1982, mortgage rates were 16%, right? Wrong time to buy? Actually, no. Because wages were rising at 7% annually. Your salary doubled every decade. You could refinance in a few years when rates dropped, and they did drop. By 1985, rates fell to 12%. By 1992, 7%. By 2003, 5%. Every homeowner from the 80s rode this wave down, refinancing their way into wealth while their homes appreciated 20% year over year in some markets. Your parents didn't just buy houses, they bought lottery tickets that always won. But the advice they gave you was simple: save 10%. Buy a house. Get a good job. Stay loyal to your company. Let's examine each piece of this advice through the lens of 2026. Save 10% of your income. Sounds reasonable, responsible even. In 1985, if you saved 10% of that $23,000 median income, you saved $2,300 into an account paying 14% interest. In 1 year, you earned $322 for doing nothing. That's almost 2 weeks of groceries for a family of 4. Today you save 10% of $74,000. That's $7,400 into an account paying 4.5% if you're lucky. You earn $333. Sounds similar? Not even close, because in 1985, inflation was 4%. Your real return was 10%. Today, inflation is running between 3 and 7%, depending on what you actually buy. Your real return may be 1%. Maybe. But here's where it gets devastating. Your parents saved 10% and bought houses. You save 10% and wait, because that $7,400 per year means you need 14 years to save a 20% down payment on that median house. 14 years, during which home prices will rise another 30 to 40% based on historical trends. You're not saving for a house. You're chasing a moving target while running on a treadmill. Get a good job and stay loyal. In 1975, the average worker stayed at a company for 4.6 years. Companies rewarded loyalty with pensions, real pensions. Defined benefit plans where your employer guaranteed you a percentage of your salary for life after retirement. In 1980, 83% of private sector workers with retirement plans had pensions. By 2023, that number dropped to 14%. Your parents stayed at companies for 30 years and retired with guaranteed income. You stay at a company for 30 years and you're leaving money on the table. Because here's what the data shows: workers who stay at the same company for more than 2 years earn 50% less over their lifetime compared to job hoppers. 50%. That's not a rounding error. That's a different life. The retirement system changed. Nobody told you. Pensions became 41s. Guaranteed money became maybe money if the market doesn't crash when you're 64. The risk shifted from employer to employee. But the advice stayed the same. College is the path to success. In 1980, the total cost of 4 years at a public university was $7,200. The median starting salary for a college graduate was $16,000. You could pay off your entire degree with 1 year of work. Maybe less if you lived with your parents. Today, that same 4-year degree costs $104,000 at a public school. The median starting salary for a college graduate is $55,000. You need 2 full years of gross income before taxes, before rent, before food, before living. But your parents don't see this. They see their degree that cost them $7,000 and returned millions in lifetime earnings. They see correlation and assume causation. I got a degree, I became successful, therefore degrees create success. They don't see that the economics have fundamentally changed, that their degree was underpriced and your degree is overpriced, that their degree was rare and yours is common. In 1970, 11% of Americans had bachelor's degrees. Today, 37% do. Your parents' degree was a signal. Your degree is the baseline. Showing up with just a bachelor's degree in 2026 is like showing up with just a high school diploma in 1970. The game changed. The advice didn't. Here's what nobody wants to say out loud. Your parents' financial success wasn't about discipline or hard work or following the right advice. It was about timing. They graduated into the longest bull market in human history. They bought assets when assets were cheap. They borrowed money when money was expensive but wages were rising. They locked in low prices and refinanced into low rates. They won the lottery and called it wisdom. But to understand why this advice has become so toxic, we have to look at what happened to the American economic engine between then and now. The divergence started in 1971. August 15th, President Nixon closes the gold window. The dollar, once backed by physical metal, becomes backed by trust, by promise, by the full faith and credit of the United States government. What happens next changes everything. Money supply explodes, not immediately. Slowly, then all at once in 1971, the M2 money supply sits at $675 billion. By 1985, it's 2.6 trillion. By 2008, 8 trillion. By 2020, 15 trillion. By 2023, 21 trillion. The money printer doesn't just go brr. It goes nuclear. Your parents bought houses with old money, scarce money, money that held value. You're buying houses with new money, diluted money, money that loses purchasing power the moment it's created. But houses don't care about money supply. Houses are real assets. Unlimited demand. As money supply grows, asset prices explode. But wages lag always. Between 1979 and 2020, productivity in America grew 62%. 62. Workers produce more value per hour than ever in history. Compensation grew 17%, not 62. 17. Where did the other 45% go? Up. To shareholders, to executives, to people who own assets instead of selling their time. Your parents entered the workforce when labor had power. Union membership hit 35% in the 1950s. Unions negotiated wage increases that matched productivity. When companies made more money, workers made more money. Simple. Today, union membership sits at 10%, wages stagnate. Productivity explodes. The gap between what you produce and what you earn grows wider every single year. And your parents look at you struggling on a $74,000 salary and think you're just bad with money because they made $23,000 in 1982 and did fine. They don't adjust for the fact that $23,000 in 1982 had the purchasing power of $75,000 today. You're making the same money, buying a more expensive life. Just work hard. That's the advice. That's always the advice. But here's the problem. Hard work was the cheat code when labor was scarce and capital was abundant. Today, labor is abundant and capital is scarce. The math flipped. Your parents competed with hundreds of candidates for jobs. You compete with thousands. Globally, a company can hire someone in the Philippines or Vietnam or Kenya for 1/5 your salary. Same education, same skills, different cost. Globalization was supposed to make everyone richer. It did. It made capital richer, because capital can move freely across borders. Labor can't. Your parents' job was protected by geography. Your job is vulnerable to the internet. Let's talk about the advice to invest in the stock market. Seems smart, right? And it is, for people who have money to invest. But here's what your parents don't tell you because they don't realize it. They invested in the stock market during the greatest 40-year bull run in history. The S&P 500 in 1982 traded at 102. Today, it's over 6,000. That's a 60-fold return. Unprecedented, historic, unrepeatable. Your parents put money into index funds in their 30s and became millionaires by accident. They think it's because they were smart. It's because they were early. First mover advantage on a scale most people can't comprehend. You're buying into a market with a CAPE ratio. That's the cyclically adjusted price to earnings ratio above 32. Historically, when CAPE exceeds 30, the next decade returns 3% annually, not 10. 3. Below inflation? You're not investing, you're hoping, praying that the expansion continues forever. That valuations don't mean revert, that we've entered a new paradigm where old rules don't apply. Maybe we have. But betting your retirement on this time is different is not a strategy. It's a Hail Mary. Don't waste money on rent. Buy a house, the most repeated advice in America. And mathematically, it made perfect sense for your parents. But does it make sense for you? Run the numbers. Median house, $436,000. 20% down, that's $87,000. Most Americans under 35 have a median net worth of $13,000. You don't have $87,000, so you pay PMI, private mortgage insurance, another $200 a month. Penalty for being poor. Your mortgage at 7% interest on $349,000 costs $2,320 monthly. Add property tax, let's say $500. Homeowner's insurance, $250. Maintenance, 1% of home value annually, that's another $360 monthly. Total monthly cost $3,430. You could rent a similar house for $2,200. That's a difference of $1,230. Invested at 7% return over 30 years, that difference becomes $1.5 million. But your parents don't calculate this. They remember that housing always goes up, and for them it did. reliably. 10% per year in many markets. Will it continue? Can it continue? When the median home price is already 6 times median income, when mortgage rates are 3 times what they were in 2020, when birth rates are falling and the largest generation, millennials, has already aged out of peak home buying years. You're not buying at the beginning of the curve. You're buying at the end, maybe past the end. Here's the advice nobody gives you. Your parents' strategy worked because of macroeconomic tailwinds that will never exist again. Falling interest rates from 16% to 3% over 40 years. Every refinance increased cash flow. Every refinance built wealth. Rising wages that doubled every decade. Houses that appreciated because boomers, the largest generation in history, were all buying at the same time. Cheap energy. Globalization that made everything except houses and healthcare cheaper. What tailwinds do you have? Rising interest rates, stagnant wages. A smaller generation with less purchasing power. Expensive energy. Deglobalization. Inflation in the things you need, deflation in the things you want. You're playing the same game with different rules and wondering why you're losing. Just budget better. Cut out the lattes. Stop buying avocado toast. The advice from people who bought houses for $60,000 and collected pensions. The math is insulting. A daily $5 latte is $1,825 per year. Sounds like a lot. That's 2% of the median income. 2%. Your parents paid 2% of their income for mortgage insurance, for property tax. For the gap between their salary and their lifestyle, you're being told that 2% is the difference between poverty and wealth. It's not. It's a rounding error, a distraction. The real problem is structural. Wages haven't kept pace with asset inflation. Period. You're not bad with money. The money is bad, but here's where it gets insidious. Your parents internalize their success as personal virtue. They believe they succeeded because they were disciplined. Frugal, smart. They don't see the system that supported them, the economic environment that made average decisions produce extraordinary results. So when you struggle, they see moral failure, laziness, poor choices. They don't see that you're running twice as fast to stay in the same place. The advice to start at the bottom and work your way up made sense when companies promoted from within, when loyalty was rewarded, when staying at one company for a decade meant climbing the ladder. Today, the ladder is gone. Companies hire executives from outside. Middle management gets outsourced. Entry-level positions require 5 years of experience. You start at the bottom and stay at the bottom unless you jump ship. The data is clear. The fastest way to increase your income is to leave your company every 2 to 3 years. Job hoppers earn 20 to 30% more over their careers than loyalists. But your parents see job hopping as flaky, disloyal. They don't understand that the company broke the loyalty contract first when they replaced pensions with 401s and annual raises with performance reviews. That cap increases at 3%. You're not disloyal. You're adapting to the reality they created. Let's talk about the nuclear option that nobody discusses. Your parents got rich because they extracted value from your generation before you even entered the workforce. How? By voting for policies that inflated asset prices and suppressed wage growth, by implementing zoning laws that restricted housing supply, by cutting taxes on capital gains while raising payroll taxes, by transitioning from defined benefit to defined contribution retirement plans, shifting risk downward, by inflating the costs of education through unlimited government-backed student loans. Every decision they made democratically through the ballot box transferred wealth from the future to the present, from you to them, not maliciously, not consciously, but mathematically, undeniably. And now they wonder why you can't just follow their advice and succeed, because the advice was never the reason for their success. The environment was. And that environment is gone. So what happens now? What happens when an entire generation realizes the dream is broken, that the advice is poison, that working hard and saving money and going to college is no longer sufficient for the life their parents had? You're seeing it already. Birth rates collapse. Why have kids when you can't afford the life you're already living? Marriage rates plummet. Why marry when financial stress destroys relationships and you can barely support yourself? Homeownership among young adults hits the lowest level in 70 years, not because they're lazy, because the math doesn't work. The psychological damage is profound. You were told that if you followed the rules, you'd succeed. You followed the rules. You failed anyway. Not because you're incompetent, because the rules changed and nobody updated the manual. That's not just financial stress. That's existential crisis. That's questioning whether effort matters. Whether anything matters. Your parents look at your generation and see entitlement, participation trophies, avocado toast. They don't see what the data shows. You're the most educated generation in history, working longer hours for less purchasing power, buried under debt that didn't exist for them, competing in a global marketplace they never faced, for wages that haven't moved in 20 years while costs have doubled. You're not entitled, you're exhausted. Here's what needs to be said clearly: the advice your parents give you isn't just outdated. It's actively harmful. Following it will make you poorer, Because it was optimized for their economy, not yours. Their economy had falling interest rates, rising wages, cheap assets, and demographic tailwinds. Your economy has rising interest rates, stagnant wages, expensive assets, and demographic headwinds. Different game, different strategy required. So what's the actual advice for 2026? What works now? First, abandon the idea that a single job will make you wealthy. Multiple income streams are no longer optional. They're mandatory. Your parents had one job for 30 years. You need 3 to 5 income sources, not because you're greedy, because single income streams are fragile, companies downsize, industries collapse, AI replaces jobs faster than new ones are created. Diversification isn't just for investment portfolios anymore. It's for income. Second, invest in skills that can't be outsourced or automated. Your parents invested in credentials, degrees, certifications, pieces of paper that proved you sat in classrooms. That's not enough anymore. You need skills that create value too complex for AI, too nuanced for outsourcing. Persuasion, creativity, systems thinking, emotional intelligence, the things that make you irreplaceable. Third, stop treating your primary residence as an investment. It's not. It's a liability that you live in. The math has changed. In most markets, renting and investing, the difference produces better returns than buying. Your parents' generation squeezed every dollar of equity from their homes through refinancing and appreciation. You're buying at the top of the market with high rates and minimal appreciation potential. That's not an investment. That's a trap. Fourth, understand that geographic arbitrage is your greatest weapon. Your parents had to live where the jobs were. You don't. Remote work changed everything. You can earn San Francisco wages while living in Boise, earn New York money while paying Tennessee taxes. This is the first time in history that labor can separate income from location at scale. Use it your parents couldn't. You can. Fifth, stop optimizing for retirement at 65. The system that guaranteed retirement is gone. Social Security will be insolvent by 2034. That's not conspiracy. That's the Social Security Administration's own projection. Your 401 isn't a pension. It's a gamble that the market goes up and stays up exactly when you need it. Build a life you don't need to retire from instead of saving for 30 years to escape a life you hate. Sixth, recognize that asset inflation is monetary policy now. It's not a bug. It's a feature. The Federal Reserve will do everything possible to prevent asset prices from falling because the entire economy is built on rising asset prices. Home equity funds consumption. Stock portfolios fund retirement. If assets crash, everything crashes, so they'll print money, suppress interest rates, backstop markets indefinitely. This means assets will continue to outpace wages. The gap will widen. The only way to win is to own assets. Any assets, stocks, real estate, businesses, intellectual property, anything that benefits from monetary expansion. Saving cash is losing. Earning wages is losing. Owning assets is the only winning move. But here's the trap. You need money to buy assets. And if you're spending everything you earn just to survive, you can't buy assets. You're stuck. This is the wealth trap, the poverty trap. The reason inequality explodes, your parents didn't face this. They earned wages that bought assets easily. You earn wages that barely cover expenses. The ladder they climbed has been pulled up behind them. So what's the solution? Honestly, there isn't a personal finance solution to a macroeconomic problem. You can optimize, you can strategize, you can work 3 jobs and invest every spare dollar and live in a van, and you might do better than your peers. But you won't do better than your parents did by following their advice. The math doesn't allow it. The real solution is systemic. Build more housing to fix supply constraints, reform zoning laws, tax land value instead of labor, implement policies that reward work instead of wealth, increase wage growth to match productivity growth, make education affordable again, rebuild the social contract that was shredded over the past 40 years. But that requires admitting the current system is broken. And the people who benefited most from the current system are the ones with the most political power. Your parents' generation. Boomers. They vote at twice the rate of millennials. They own 80% of the wealth. They control Congress, the Supreme Court, corporate boardrooms. Why would they vote to change a system that made them rich? They won't. Not willingly. Not until the math becomes undeniable. Not until their own children and grandchildren suffer so visibly, so obviously that denial becomes impossible. We're approaching that point. Student loan debt exceeds $1.7 trillion. Credit card debt hits $1.1 trillion. Auto loan debt, $1.6 trillion. Total household debt, $17 trillion. These aren't just numbers. These are millions of people drowning, working full-time and still needing food stamps, earning degrees and working retail, following all the advice and ending up worse than their parents. At some point, the system breaks, not because people revolt, because the math stops working, because you can't extract wealth from people who have no wealth to extract, because debt-fueled consumption hits a ceiling when everyone is already maxed out. What does collapse look like? Not dramatic, not sudden, just slow decay. Fewer people buying homes, fewer people having children, fewer people starting businesses, more people living with parents into their 30s, more multi-generational households. More gig work, more side hustles, more desperation masked as entrepreneurship. The American dream doesn't die with a bang, it dies with a whimper, with millions of people quietly accepting that they'll never have what their parents had, that working hard isn't enough, that the game is rigged, that maybe the dream was always a lie. But here's the thing about lies, they only work if people believe them. And your generation stopped believing. You saw your parents follow the script and succeed. You followed the same script and failed? You're not stupid. You can pattern match. You can see that the variable that changed wasn't your effort, it was the environment, so you're opting out quiet quitting, lying flat, fire movement, van life, digital nomadism. These aren't trends, these are adaptations. Survival strategies for an economy that no longer rewards traditional paths. Your parents call it laziness. It's not, it's rational response to irrational incentives. Why work 60 hours a week if it doesn't lead to prosperity? Why buy a house if it bankrupts you? Why have kids if you can't afford them? Why play a game you can't win? The advice your parents gave you wasn't malicious. It was obsolete. They succeeded in spite of their advice, not because of it. They succeeded because they lived through the greatest period of wealth creation in human history with macroeconomic conditions that will never exist again. You're living through the hangover. The bill coming due, the realization that you can't print prosperity forever, that inflating assets without inflating wages creates a ticking time bomb, that you can't build an economy on debt and hope and ever rising home prices. Your parents' money advice worked for them. Following it will make you poor, not because you're doing it wrong, because the world changed and the advice didn't. The question isn't whether their advice is bad, the question is whether you're brave enough to ignore it, to build a new playbook for a new economy, to stop chasing their version of success and define your own, because their dream is dead. But maybe that's okay. Maybe you build something better, something sustainable, something that doesn't require exploiting the next generation to fund your retirement. Or maybe you don't. Maybe the decline continues. Maybe America becomes a nation of renters working until they die, never accumulating wealth, never achieving stability. Either way, the advice stays the same: save 10%, buy a house, get a good job, stay loyal. And either way, following it will make you poor,